How do private equity investments compare to public equity investments? So which makes more money? Private equity investments or public stocks? Most people assume public stocks are the way to go to grow their wealth, but the truth is private equity has outperformed the stock market for decades. In this video, I'm going to show you how. Let's break it down. If you're only investing in stocks, then you're missing out on some of the highest returns available in the market. In this video, I'll show you why private equity has outperformed the stock market, how they do it, and how you can get in it. Want to know where the smartest people put their money? It's not just the stock market. Stick around and I'll show you how private equity stacks up against public investments. And then you can see which one will be a better play for you. So by the end of this video, you'll understand the difference between private equity and public investments, which one performs better over time, and how to decide which one fits best for your investment strategy. So what's the difference between private and public equity? Public equity, very simple. It's stocks. It's on the NASDAQ and the New York Stock Exchange. You can buy and sell stocks on any investment brokerage website. Private equity, investments that are in real estate, in businesses, and in funds that aren't publicly traded. Key distinctions. Public investments are highly regulated and liquid. There's a market for them. Private investments are highly illiquid, and they have strategic advantages against public investments. So how do these two stack up? Historically, how have they performed? Over the past 20 years, private equity has consistently outperformed the stock market, the S&P 500, for the last 20 years. Here's the comparison between Cambridge Associates Private Equity Index versus the S&P 500 returns. Private equity yielded 14 to 18% average annual returns over the last 20 years. The S&P 500 averaged 8 to 10% annual returns. So why is this the case? Private markets allow for longer hold periods, operational improvements, and strategic exits. So why does private equity have a performance advantage over the public stock market? Number one, less market volatility. Private investments aren't subject to stock market swings through market forces that you can't control. Number two, control over the assets. In private investments, operators and investors can improve cash flow, improve operations, and ultimately drive value to the asset. Undervalued assets and inefficiencies in pricing. Unlike public stocks, private investments aren't priced efficiently. This creates high upside opportunities when acquiring a value-add business or piece of real estate. Lastly, tax benefits. Private equity investors benefit from depreciation and other tax benefits that public investments do not offer. So we're going to focus on the different aspects of public equity versus private equity, and I'm going to break down the pros and cons below. Liquidity. Public stocks. The liquidity is high. You can buy and sell at any time. Private equity. The liquidity is low. Capital is locked in for years in the investment. Returns. Public stocks get 8 to 10% on average. Private equity, 14 to 18% over the last 20 years. Risk exposure. Public stocks are affected by market fluctuations and macroeconomic shifts. Private equity has less market risk exposure and it's more focused on operator execution and the individual asset performance. Volatility. Stocks have a high volatility and daily prices can swing. Private equity has low volatility. No public market fluctuates the price. Tax benefits. Public stocks have limited tax and are taxed at capital gains. Private equity has depreciation benefits, tax deferrals, and 1031 exchanges are an option. Why the ultra wealthy invest in private equity? Let's follow the money. Institutional investments like pension funds, endowments, universities, they allocate anywhere between 30 and 60% of their portfolio in private equity investments. They focus on this so they can get better risk-adjusted returns than the public markets. Billionaire investors like Ray Dalio and Warren Buffett prioritize real estate, private debt, and private equity as an alternative investment asset class. Private markets allow for exclusivity and access to deals that just aren't available on the public market. How do you start investing in private equity as a retail investor? Number one, decide if private equity fits your risk tolerance and your time horizon. Number two, choose what type of private equity investment you want to invest with. Number one, private equity funds. Number two, real estate syndications. Number three, venture capital. Or number four, buyout funds. Next, research and vet the investment general partner or sponsor. Make sure to look at their track record, the transparency of how they communicate to investors, and their long-term strategy if it aligns with your goals. Start small. Invest a little bit in a few different investment partnerships or vehicles and see how it complements your portfolio. Now that you know how private equity compares to public investments, let's dive into the next video and go over how to analyze private equity deals. This will help you analyze investment opportunities like businesses or real estate purchases like a pro. Click on the next video and check it out.